This is Tim Phillips, Chief Investment Officer at Phillips and Company Advisors. I'd like to thank you for tuning into our Q2 2023 look ahead. Please read all the disclosures carefully. It's hard to deny the consumer continues to reflect great strength. The pace of new jobs has been exceeding forecasts, albeit with a little slower wage growth, but they're still holding excess savings to the tune of 5% of GDP, and they're still well below prior high watermarks for debt service and financial obligations. So all looks really good for the consumer. However, the one thing to watch is confidence levels, especially in light of recent bank mismanagement failures. Consumers must have confidence to consume, and that has ticked down as of recent. There's an ongoing debate between jobs and inflation. The theory goes that without slack in the labor force, you're going to see ongoing inflation. Not so fast. What should matter is wages versus inflation. As we pointed out in the last slide, wage growth was the smallest in a year. Workers aren't quitting their jobs at prior peak levels, and the employment to population ratio reflects more workers coming into the workforce. Both bode well for moderating wage growth. You can see that from the chart in the lower left that wage growth from job switchers is also falling, and that should also help moderate wages. The Fed watches service inflation, less housing, very closely, and that also has started to roll over. And the all-important owner's equivalent rents, what people pay for housing, is coming back down to more manageable levels. All of this should support a moderating inflation picture in the months to come. There's a lot to unpack when looking at banking and credit, so bear with me as we do this. Let's start with mismanagement by the banks. All of us should come to realize that when we make deposits into savings and checking accounts at banks, we're really loaning the bank our money. They then take that money and make loans and investments. In that vein, lots of banks invested in longer duration treasuries, between 5 years and over 15 years. And we've sampled a few for you here in this upper left-hand table. While credit quality was never really a problem, the issue arose with duration risk, which was very high. The longer the duration, the further price of the bonds would fall in a rising rate environment. And that's exactly what we've been in, a rising rate environment. In fact, banks are sitting on over $600 billion if they mark to market those losses in those bonds just on the bonds alone. Forget about any low interest loans they made, which could add to losses if they tried to sell those loans to raise cash. Now let's put all of that aside for just a moment and realize banks pay us virtually nothing for our deposits, and we can now go out and get 4% plus in shorter duration treasuries or money market accounts. So we should expect we should expect savers to continue to move money out of the banks in the coming months unless those banks pay up for deposits, which we know means they'll start to lose margin. Profits will get very hard at small and regional banks. They're going to have earnings problems ahead, and more importantly, we will all end up facing a little bit of a credit crunch. Now, the real problem is small and mid-sized banks provide much of, if not most of the credit for things like mortgages, consumer loans, and commercial real estate. As banks deal with those earnings issues in the bank, they'll have to tighten up credit and make fewer loans. And that's even happening before this bank failure headline woke us all up. Senior loan officer surveys suggest less willingness to lend. So this should all play out in the coming quarter, and it should create some opportunities for us to deploy cash accordingly. So in light of all the banking mismanagement, what's the Fed going to do? While we have maintained a higher for longer outlook for interest rates, we might just have to pivot. The one thing the Fed can do to shore up all the long duration bonds is actually cut rates. That will also help banks compete for better deposits. You can see deposits at both large and small banks have been running out the door. While we just had a 25 basis point rate increase, to cool inflation expectations, Wall Street is now calling for 3 rate cuts later this year. However, the Fed's expecting to hold rates at these current levels throughout the year. This gap will create lots of market volatility in the coming quarter. Further, the Fed is now expecting overall GDP growth to come in at just 0.4%. Now, when you think about Q1 GDP, that's expected to come in at over 3%. We would need 3 quarters of negative GDP just to get down to the Fed's 0.4% expectation. Now, in my book, that would be a recession. Let's see if the Fed won't cut rates in light of a rapidly declining macroeconomic outlook, or if the economy is stronger than even the Fed expects and they hold rates higher for longer. Our vote is for some cuts to occur in Q4, which should support equity prices. Let's just pivot for a moment to earnings, as I believe earnings matter most. Expectations are for earnings to shrink in Q2 and post a very anemic growth in Q3 with just a little more strength in Q4. Full year will be close to flatline for corporate earnings. Valuations are normalizing close to the 10-year average, and that's good. But let's not rush the door in light of these negative earnings expectations. It's a little counterintuitive, but investors trade on future expectations, and historically, some of the best equity returns come when earnings are really bad. And you can see that in the chart in the upper right. Now, combine all of that with some record stock buybacks, and we can see a real nice surprise to the upside for U.S. equity prices. Emerging markets earnings directionally mirror U.S. earnings. Weak quarters to come with a strong recovery in Q4. Valuations, on the other hand, are much better for emerging markets than U.S. earnings. Overall macroeconomic growth looks strong for emerging markets, especially when you consider China's opening up. As our friend and best-selling author Morgan Housel says, the trick is not minding the pain. And I think that's a great motto for investing in China. Great promise with some pain along the way. Take a look at our quick video we did with Morgan Housel on the link below all the data tables. China's high-frequency data reflects a rapidly recovering consumer. Traffic is back, property sales and auto sales are on the mend. GDP expectations are for 6%, while the party only expects close to 5% growth. So some opportunity for an upside surprise there. Valuations are very low at 12 times, and earnings per share growth is nearly 20%. We remain optimistic on China's return potentials, even if in light of the anti-China rhetoric out of Washington, D.C. Developed markets like Europe and Japan reflect a more optimistic earnings picture. Valuations are still relatively cheap, but expectations for economic growth are turning down. We would expect the U.S. banking crisis and credit crunch to crimp European Union growth and put a strain on their credit availability. We are re-examining our weightings to developed markets with available cash and a consideration to rebalance. While much of this look ahead has been focused on interest rates, let's just look at fixed income. With rate expectations heading south through the banking crisis, we've seen a recovery within the fixed income asset class. The yield curve, as of this recording, is still inverted, but a protracted growth air pocket in the U.S. economy can fix that rapidly with rate cuts. Money markets are flush with cash due to banks' opportunity costs, and we could see some of those funds continue to push down yields as investors seek better credits, better returns than what banks can provide. Moving closer to duration benchmark, kind of around that 6-year area, is on our minds in the coming quarter. You can read our summary views and recommendations here. The bottom line is we expect a mini credit crunch in the coming quarter, and that will help moderate growth and inflation. The Fed could be poised to make rate cuts in the second half of the year, depending on their response to fixing bank earnings. The consumer should remain resilient with a strong jobs picture, and the Chinese consumer can prop up global growth, in the quarters to come. We would encourage investors to maintain some strategic liquidity as we work through this part of the cycle. We are reevaluating our weightings in developed markets. We continue to bullet short duration treasuries if yields creep up above 4.4%, but we will likely move closer to benchmark duration as the quarter unfolds. We've been moving out of defensive in US large cap to capture some growth with a move to core in anticipation of lower rates in the second half of the year. Our valuation dashboard should provide you a few interesting hotspots where allocations could be made with fair value. Thank you for taking your time to view our Q2 2023 look ahead. Of course, if you have any questions at all, please don't hesitate to reach out to your advisor, or you can reach me on this email link below.